Seth, a little bit of relief here in the markets. Has the backdrop changed, though, pointing toward more recessionary signals just in the last few days?
Well, I think the big change in the outlook very much is this escalation in trade tensions. We've been saying now for over a year that people really need to take trade wars seriously, that they could, in fact, have a substantial hit to the economy. And we're worried that not only with the increase in tariffs we saw that went into effect in May, but with this new wave of announcements that are supposed to hit on September 1, we could actually see a material slowing in the economy starting in the fourth quarter of this year and going into next year.
Driven by the U.S. consumer?
Driven importantly by the U.S. consumer. This last wave of tariffs are going to hit primarily consumer goods, and that's going to matter.
But it's $30 billion on a multi-trillion-dollar economy. Why should it matter?
Well, I think that's been the standard calculus that lots of people have done, including the Fed, and I just don't think it's quite capturing what's happening. If you look at what's happened so far with tariffs, the imports of those intermediate goods to production that were under tariff from China just plummeted, and you can see this in the actual data. And if people are not importing the intermediate goods that are being turned into output, there's no way they can be making the output. So it has a much bigger
It's got a multiplier effect, I guess, of some kind.
Exactly. You can't just take the dollar value of the imports and the percent of the tariffs, multiply them together, and get the effect on the economy.
Yeah, I would think the confidence factor there as well. David, so given the escalation in trade tensions and now currencies, does your outlook for stocks and earnings for the second half change?
Well, it does hurt earnings a bit, and I think earnings growth is going to be slower than the analysts have forecast. I mean, analysts are still talking about double-digit growth next year. I think there is no way that's going to happen. But I think investors need to hold their nerve here. I mean, trade wars are so destructive that they tend to burn out, and I agree that this trade war will likely last into next year and possibly all the way up to the next election. But beyond that, there may be peace. And I think if you're a long-term investor, you've got to look through, yes, there's some softening in the U.S. economy, there's some softening in the global economy. I think the global economy will bounce back a little bit better or a little bit quicker than the U.S. economy here. But we've got a year and a half maybe of slowness, maybe touching negative GDP at some stage. But in the long run, there will be a trade war settlement. Tariffs will come down again, I think. And I think that will reward long-term investors. And particularly it suggests that long-term bond yields are just too low here.
Seth, do the tariffs actually help stoke inflation, which might not be the worst thing?
So not in the long run. I thought Vice Chair of the Fed Board, Rich Clarida, had the best phrase about this. He said, tariffs raise prices, they don't raise inflation. And so in terms of the monthly prints, you'll see for a little while an increase in measured inflation. But that's just as prices adjust up to these new taxes. And then once that has worked its way through, it doesn't do anything over time to inflation.
David, which groups are most vulnerable going into this new round of tariffs and the sort of reduced earnings you're talking about as a result of trade?
Well, I think consumer discretionary sales, it's going to be tough. I mean, I think consumers will get hit by this. I think there is obviously the tax effects have all faded here. Now you put these tariff increases on. I think you will see a much slower growth in consumer spending in the second half of the year and going into next year. So I think particularly consumer discretionary spending is somewhat vulnerable here, but also a lot of investment goods, because we are an exporter of capital goods, and the problem is that other countries are weaker because of this. They don't want to buy our investment goods. So I think capital goods exporters are also pretty vulnerable to what's going on right now.
David, I know you've done a little bit of work on immigration, or the lack of it, both legal and illegal, I suppose, and the impact on growth. Share some of that with our viewers and how it's impacting your overall long-term view.
Yeah, I think that it's one of the big negatives here is there's such a focus on the issue of illegal immigration that we're missing out on the fact that because of the retirement of the baby boom, we desperately need qualified legal immigrants. In fact, this year, the growth of the working age population in America, people aged 18 to 64, is only going to be 0.2%, and all of it is going to come from people who were not born in this country. And what I'm worried about is when I look at the monthly visa data coming out of the Department of State, the State Department, what we're seeing are declines in both non-immigrant and immigrant visas for the third year in a row. So we're seeing fewer and fewer legal immigrants, and that is going to be an absolute drag on growth. We are running out of available workers. That re-cements us in at less than 2% growth for the long run, unless we come to some agreement to increase legal immigration while the baby boom is retiring.
It sort of brings up an interesting question, Seth, about how much that's going on in the backdrop of the economy is secular and demographic based, and also what's happening with interest rates. PIMCO also mentioned in a note talking about U.S. negative rates, the fact that more people are aging and saving and technology and all of these sort of big picture trends we don't talk about on a daily basis that have to do with the markets.
No, I think that's right. And I think there is clearly this long-run trend. One of the things that we always try to caution people about when they're looking at the labor market is how much of it is this secular trend, people getting older, the labor force participation rate falling. But if you look within that, within the prime age workers, people between the ages of 25 and 54, you actually see that labor force participation rate rising over the past several years. So you have a cyclical component within the structural component. And that's one of the reasons why we've actually thought the labor market can actually continue to grow for a while. The Fed's fear of an over-tight labor market for years now has been overdone because there actually is a cyclical component that got masked by the structural component.